Personal finance practice problem using OneNote. APR to installment loans comparison. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problem tab down in the 5177 APR to Installment Loan Comparison tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're considering the APR on installment loans, noting that the APR will differ from the interest rate. It'll typically or always be higher than the interest rate, or it could be even if there were no fees that were involved. And it's going to be useful for us to do comparisons between loans. Now here we're thinking about two loans that are going to be installment loans. So note, when you're thinking about loans and interest rates and whatnot, there's various things that financial institutions can do to trick you or confuse you. They might not even be trying to confuse you. They're trying to package the loan in a way that's going to be a marketable way, possibly to try to increase the communication. But these things are somewhat complex when you're talking about time value of money. And just the fact that you have different structures of the loan can be confusing. And for sure, there will be some people trying to trick you with it, right? So in this case, some of the things that could happen is they could represent the rate for something other than a yearly rate or something like that. Use monthly rates, use different compoundings. Here, we're going to assume it's an installment loan, so the structure is fairly format in that we're going to think about different types of installment loans and comparing and contrasting them, those being loans that we pay back in standard types of intervals, typically on a monthly type of basis. We have an amortization table generally related to them. So a loan structured like that then could still have a component of confusion, and that's usually where we have the rate. And then we have these fees that are going to be charged. So those two things, to me, as the person that's taking out the loan, are basically the same, right? You can call them something else that, like, the person generating the loan is going to say, well, yeah, the interest rate is there because that's going to be like the rent on the money that you're paying, and the fees are what we charge to set up the loan and so on. Well, whatever, to me, it doesn't really matter. I just want to know, you're charging me money. How much am I paying, and how can I compare that to other loans, which might be charging me more or less money? It can be a little bit confusing when you break these two things out, because the interest rate and the fees are being formatting these costs in two different formats. So if we have a situation like this, where one loan has a larger interest rate but less fees, another loan has lesser interest rate but more fees, then it's difficult to make the comparison between those loans because of the difference in the format. The APR might be a way that we can roll the fees into the one percentage number and make an easier kind of comparison between the two. Because remember, that's the point of ratios oftentimes. The ratios help us to do some comparisons when we have these kind of unevenness or differences that will be involved. It's not perfect, but it's a good number to look at. It's one stat to take a look at. So we have then the loan, first loan, we got the $30,000 loan. We're going to say it's an 8% rate, 2-year loan. It's going to be paid back in monthly components, standard installment loan. The fees for it are going to be $500. We're going to assume that $500 is going to be taxed onto the loan, which is typical, meaning if you needed $30,000 for like a car or something like that, or you need $30,000, they're going to give you $30,000. They're going to say, we're going to charge you $500 just to set up to create the loan. They're going to take that money up front for creating the loan, tack the $500 onto the loan so that your loan is now not $30,000 but $30,500, meaning then that you'll be paying interest on not just the $30,000 but the $30,500 over the term of the loan, in this case 2 years. The second loan, we have a $30,000 loan, but the interest rate is at the 7.5% lower rate, still a 2-year loan. The time frame is the same, but the fees now are higher at the $800 versus the $500. So the comparison then, which one is going to be better? Let's take a look. We'll start off with the first one here. That's going to be the $30,000, 8%, 2-year, $500 on the fees. So we'll do the quick calculation, then we'll make the amortization table. We would typically do these kind of calculations. I would do them in Excel. I recommend working this in Excel. We do have this in an Excel problem if you want to take a look at it. Also, these are kind of using present value concepts. If you want to take a look at the present value concepts and focus in on those formulas, we do have a whole section on that. You could take a look at that. So we've got the payment. It's going to be calculated thusly, negative PMT. Now you could put the negative in front of in the formula, but when I like to put it, up front for some reason. I think it's easier for me. That'll flip the sign. So PMT, we're going to put the brackets. The rate then is going to be the 8%. That's a yearly rate. Remember, whenever you're given the rate, unless they say otherwise, typically it's a yearly rate. So we're going to divide it by 12. And then we say comma, number of periods. Number of periods would be 2 periods, years, but that would be yearly. And we're doing this monthly, so we're going to say times 12. And then comma, the present value. The present value is the loan, but not just the loan, because they tacked on the $500 that we're going to be paying back as well. So it's $30,000 plus $500, $30,500. That then gives us the $1,379.43. And then if we think about the APR, I'm going to think about the monthly APR first, and then we'll convert it to a yearly APR. So we're going to use the rate formula. Now, there's just the rate formula. You would think if you say, well, if I do the rate formula, I'm just going to get back to the same rate of 8%, right? And you would, but we're going to twist it a little bit in that we're not going to include the fees when we get there. So that's the twist. I'll tell you when the twist happens. There'll be a twist in it when we do this. So it's going to be the rate, and then it's going to be the brackets, and we have the number of periods. Number of periods is once again 2 years times 12, and then comma, the payment now, and it needs to be a negative. This time I don't think I can put the negative up front. They make me put the negative in here. So a negative on the payment, and the payment is the payment we calculated, the payment being calculated on the $30,000 plus the $500, and then comma, the present value not being this time the $30,000 plus the $500, because if we did that, we'd get to the monthly equivalent of 8% a year, which we get to 8% if we multiplied it times 12. We don't want to do that. We want to not include the 500, just include the loan, rolling in essence, the fees into the rate, and that gives us our monthly rate of the 0.80737%, which is low because that's the monthly rate, which we could make yearly by just tacking on after the brackets times 12. But I'm going to do that in a separate tab here. So we're just going to take that monthly rate, multiply it times 12. So if we just put up the trusty calculator, monthly rate 0.008037 times 12 is going to give us that 9.644 and so on. So obviously the APR being greater than the 8% rate because we rolled it in. Now just note that when you make the amortization table, you're not using the APR because what you're doing is you're starting with a loan of the $30,500 and you're using the 8%. That $30,500 already includes the 500 fees that they charged us for, and now which we're going to be paying interest on. So when you do your loan calculation, you could say, and this is easy to do in Excel. Once you do it a few times, I highly recommend doing it in Excel. It's not easy, I guess, but like if you do it like 100,000 times, like I've done it, then it becomes easy. Now I've done it kind of a lot though. But so in any case, if we take the 30,500 times the 0.08, which is the interest rate, which is not the APR but the interest rate, then you get the 2,440. And if we take that then and divide it by 12, because that's the yearly, we want the monthly, we get the 203. So then if you take the 1379 minus the 203, you're going to get the 1176. And then if we take the 30,500 minus the 1176, you're going to get the 29324, and so on and so forth. If you do this down, I won't do the whole thing or anymore because we've seen these a little bit in the past. So if you want to work on your amortization tables, you can look at prior problems. But note that the point is we put the loan on here at the 30,500, not the 30,000. And when you build the amortization table, it's not built using the APR. It's built using the normal interest rate. The APR is what we used in order to kind of roll in that 500 that's included into the loan, so that we can get a rate that would be a comparable type of rate. Now, you can plug this information into, say, an online calculator too, if you so choose. And so you can put this is just one online calculator. You can just type in APR calculator online in your favorite browser like Google or something. 30,000 Loan term, 2 years. The percent is going to be 8% monthly on the APR every month. $500 on the loan fees, and that gives us the amount financed, $30,500. The APR at the 9.645. 9.645, and is that what we got? It is. Yeah, it is. Of course it is. And then we've got the every payment month, $1,379.43. So $1,379.43, and so on. Total payments $33,106. So if you were to add up all the payments down here, adding this up, or just multiplying the payments times the total periods, which are 24, $33,106. And then we've got the total interest, $3,106 on the interest. Notice that's a little tricky because if you add up the interest column, it comes out to the $2,606, and they added the fees to it plus the fees. So what they charged you is the interest, which you charged interest on the fees, the $500. So you paid interest on the fees, and they charged you the $500 fees because you didn't need that $500. You're paying them the $500. So you paid the total interest, $2,606 plus the $500. The interest and fees you paid over the life, 24 periods in this case, $3,106. Let's look at the second one. This one, we got a $30,000 loan, but the rate is 7.5. Better rate we found, but they charge us more fees. Better rate, more fees. Let's do the same calculation. We're going to take the payment calculation equals negative PMT brackets the rate. The rate is going to be then the 7.5% this time divided by 12. 7.5 divided by 12 to get the monthly rate, comma, number of periods. Number of periods would then be the 2 years times 12 to get to the 24 periods, comma, and then the present value, not the $30,000 because they tacked on the loan, $30,000 plus the $800, $30,800 would give us a payment that we're going to have to pay each month of $1,385.99. If we then take a look and say, well, what would the rate then be at the APR? We got that one twist here. Remember this, we're going to do the rate, but there's a twist. So we're not going to get to the 7.5 because we're going to apply the twist involved. So we're going to say this equals the rate, and then the number of periods. Number of periods would be 2 times 12. 2 times 12, comma, the payment is going to be the payment we just calculated. And then we have the present value. Notice the payment has to be negative too. You can't put the negative up front like I like to do with the payment thing up here. You got to put it here on the rate formula. And then we're going to say the present value is not going to be the $30,800 because if we use $30,800, we get back to the 7.5%. Instead, we're just going to use the $30,000, which will kind of roll in to the rate, the fees, and that's the idea. Now, we could close it up and then multiply it times 12 to get the yearly amount, but I'm going to do that in a second calculation. So this would be the monthly amount, and then we just take that number and multiply it times 12, which would be the 0.008432 times 12, and that would be the 10.1184, and so on. So there we have it. Now then, if we put that into an amortization table, we won't do the whole amortization table, but just remember that first number is not going to be 30,000. We only needed 30,000, but they are going to make us a loan of the 30,800 because they made us pay them 800, tacked it on to the loan. So therefore, that 800 is included in that balance. And when we do the amortization table, we're just going to use the 7.5%, not the APR of the 10.1184. So we would be taking the 30,800 times the 0.075. That would give us the interest for a year. We take that, we divide it by 12 to get the interest for the month, about 193. We take the payments, which we calculated up top here to be the 1385 or 86, about 1386 about minus the 193 about gives us about 11793. Then we take the 30,800 minus the 1193 about gives us about 29607. 29607. We can of course plug this in our trusty online calculator. Same scenario, except the rate now is at the 7.5, and the cost of the loan was, in terms of fees, $800 now, $800 on the fees. Let's run it, run the calculation. Before I forget, just note you can get the amortization table with these things as well. I like to double check it in Excel because you have a lot more flexibility to do what you want to do. Whatever you want to do, you can do it in Excel, whereas here you're somewhat more limited. So I like to use these as kind of more like a double check and then run it in Excel personally. But either way works, whatever you want to do. So we're going to say 138599, 138599, and then the 30,800, we got the 10.119 on the right. So the 10.119, about 10.119, and it rounded up. I think it would round up in any case. And then we've got the total payments of the 33,263 and the interest at the 3,263 on the interest, 3,263. If we scroll all the way down here, the loan goes down to 0. We got the interest of the 2,464 plus the fees of the 800, 3,264 about in terms of the interest and fees. So if I was to compare and contrast these two, we can look at the APR. This one has a 10.1184 versus this one that has a 9.6. So you want the lower APR generally, and so that would be the first one here. In this one, even though it has the higher rate, it has the lower APR. Now, the one caveat, as we saw when we do a comparison in like a home loan situation, or one of the caveats when a home loan situation, is that if you have that long-term loan, then you've got to determine the timing difference if you're not planning on having the loan for the extent of the loan, meaning obviously these calculations are being calculated over the term of the loan, in this case 2 years, which in this case you'd probably be looking to have the loan for 2 years. But if it was a home loan over 30 years, you may well take out the loan not planning on keeping it for 30 years, selling the home and then paying off the loan possibly at an earlier point, in which case you'd have to consider meaning a finance company may allow higher fees up front in exchange for, in essence, a lower rate, which could cause a lower APR over the term of the loan, which in that case might be a 30-year loan. But you got to make the trade-off of the fact that they're increasing the loan balance, basically taking the payment in essence up front, and then offering the lower rate in exchange for that. So there's going to be a trade-off in terms of timing, how long you have the loan, because that trade-off plays out over the entire 30-year time period when you figure the APR. Therefore, if you have it for less than the full time period, you got to do a little bit more thinking in terms of what the best comparison will be. We do have another practice problem on that if you want to take a look at that in a bit more detail.